160% live last week on YouTube trading 0-day options during the toughest time ever, the FOMC meeting. I want to unlock the 0-day strategy I used, so hopefully you can hit big wins consistently and stop struggling with short-term options. So let's get right into it. What I'm going to be doing is going over the FOMC trade we put on last week, showing you how we made over 100% return in 30 minutes. So this is the trade setup. As you can see, we were entering down here at that first breakdown. And this is the live stream as well. You can see my entry live. I was entering on that first dipping candle. So there's a reason why I did that, and it's super important to understand inside this video. That's what we're hopefully telling you. But as I fast forward to the trade, you can see, took a little espresso break, but we had a 40% rip once, 40% rip twice, and we did not sell our full position because this is what we wanted to do, is hit this move. Boom, high of day. Low of day to high of day is the key if you want to be successful as a trader. Trading that range is going to lead to huge profits and great risk to reward. So that entry down here, up there is around 170% return. As you can see on my screen, 130. And then at the end, when we finally hit our profit target, 173%. So how did I do it? What's the magical secret? Because you've seen me on FOMC hit over 100, 200% wins 3 out of the 5 last times. Everybody thinks trading is gambling, but I'm going to prove you wrong. So number one, you have to have the right risk to reward setup if you ever want to survive with 0 DTEs. This is where you cannot shoot for 40% gains. You can't shoot for 30% gains because guess what? These options are going to 0. So even if you hit like a 20%, 10% win, if one trade goes to 0, you don't manage your risk. You're giving up 10 to 5 winners if you're taking those small risk to reward, small profit opportunities. So the reason why I use 0-day options on FOMC is because that historically is the 1-day options run 200, 500, 1,000%. So when you're hitting a 200% win, a 2-to-1 risk to reward states you could lose the whole next trade and still be profitable if you hit one winning trade. So whenever you have that opportunity to hit over 100% wins, that's when 0 DTEs make sense. But if you're not targeting 100%, you're putting yourself in a huge position to lose. And that's why we put our stop loss at 50% minimum. So I don't want to lose 50% in an options trade ever. And 0-day options, once they hit that limit, they're typically never going profitable. So it's important to understand that's like the graveyard stop loss. You can let them run to 0, but you have to be targeting 200% wins. And honestly, I would never let options run to 0 because even if it's at a 90% loss, it's still money you can keep and take out. The last thing you need to understand if you're going to hit successful trades with 0 days is trailing stop losses. And this is crucial. If you cannot trail a stop loss, you're going to get devastated in the markets. So let me show you exactly why you need to understand this stop loss management and managing a trade midway. Because let's say, for example, you were long the markets over here. Like you entered this breakout right there and you were long and making money. So during this trade, you're shooting for 100%. But let's say you go from the breakout to the high and you're at like 70%. You haven't taken profit, but your stop loss is still at a 50% loss. The problem is one candle can wipe out your gains and more. So if you're shooting for that zone, let's say your stop loss is here. If you have this setup here and you took the breakout, like I said, at this zone here, you're up, you're winning, you're shooting for a little bit more profit, and then this candle just takes you out. More importantly, if you don't have the stop in, it takes out your whole position, your initial capital, and that can go straight to 0. So what I typically do is if I hit halfway to my profit zone, I'm taking my stop and moving it up. So what that means is if my profit zone's up here, you want to measure halfway, and that will put you at right there. And so once you hit half of your profit, which is this level right here, you don't want to let the trade go red. So stops should always go to break even. In that case, you can trail some. You can take profit off, a little bit of profit off halfway. You can trail your stop loss a little bit more aggressively. But the point is, don't let a green trade go red, especially on 0 days, because that's when your account can go to zero really quickly. It's pretty emotional when the candle rips without you knowing, without you being ready, and then you're trying to average down, then you're angry, then you're emotional trading. It can really wreck you being on that shorter time frame and making bad decisions. So again, once you hit that 50% profit, you want to make sure you aggressively manage your risk on 0 days. And what this means, fam, is everybody out there who's on the bad trading platforms like Robinhood, some of the platforms don't offer trailing stop losses like Fidelity, or some of the ones like Webull. You want to make sure you're on the right platform that you can put a stop loss in and a profit order. It's an OCO at the same time. The idea is when the trade's running green, you drag your stop loss up as it goes. Drag it up as it goes. So it's important to understand that. If you can't do that, you shouldn't be trading 0 days. So while the strategy I'm teaching you is exciting, is successful, and does well, doesn't make sense to do this on a bad platform where you can't have a stop loss that you can move and enter easily. So here's how I've been consistently crushing 0 days with FOMC. This strategy does apply to every single day in the markets, but it makes you more money on FOMC because of some other factors that we don't have to get into now. But the first thing I always look for is the initial move on FOMC. I am always looking to fade the initial move. If you fade the initial FOMC move, that's where you have the best risk to reward, and typically you get the reversals around 12:30. So I'm gonna go back here. We entered on that first breakdown, like I showed you, that first blue candle down, and that's around 12:03. But that was a large move, and so you could have entered again at 12:18, 12:20. The thing you want to understand is that when you move to a extreme of a range, so like the range of the day for SPY was high and low right here. So if you look at the range and you're wondering like, hey, where's the best time to buy a put? Where's the best time to buy a call? You want to be buying at the discounts. So calls are bought down here if you're looking to play reversals, and puts are bought up here. This is what gives you the best risk to reward. And so if you buy at these extreme ranges, you can get the biggest profits and the biggest moves. And during FOMC, historically, the reversals are always happening around 12:30 to 12:40. So if you grab the biggest discount given to you on FOMC, you're going to get a clean opportunity to hit 200 to 500%. So what happens is, like I said, Papa Powell comes on and he introduces the future, he starts talking, and then volume comes in, and now you start seeing this gets interesting. We run 130% on this move, and we're still targeting the high. So going back to the strategy, we are fading that 12:15 move, and then we're targeting the opposite side of the range. This is still applicable to trading every single day in the markets, and I'm going to show you why. But here's what happens again. We come all the way up, and we don't even hit the highs. It kind of falls short, just a little couple cents there. What you need to understand is that we're now at a good place to buy puts. You always want to trade your reversals at your key areas for best risk to reward, best discounts. So if you're trying to buy puts today in the market or during FOMC, where do you want to buy puts? I just told you guys, up here. You want to be a put buyer wherever you can get the biggest put discount, because if you measure your risk to reward, you want to shoot for the low. And if you're shooting for the low You want to be buying puts at the high if possible. That's your biggest risk to reward opportunity. And if you understand the concept I just said, you'll be far better off as a trader. Playing the extremes offers the best risk to reward. And I would just drag this to a 2-to-1 risk to reward. And once I have confirmation, that's when I would buy puts and go short. And the crazy thing is that puts were actually the bigger paying play. As you can see, FOMC tanks, really continuously tanking here through the low of day and more. So the beauty of FOMC is you make that 500% return on the break from the higher low. And so we break the low of day and those options went bananas. So we traded the first reversal, but there's sometimes a second reversal on FOMC that's just as powerful. Because if Powell says anything at 12:45, that's when the market reverses for 30 minutes. And he can use that momentum can be used to hit that massive win. And that's only possible and only risk to reward sets up if you're hitting the discount area for puts. And then this again is discount area for calls. If you're not hitting those areas, then you don't want to be buying puts or calls ever in the market. So that's the one thing you need to understand if you want to be successful as a trader. The discount is the key. And this is reversal discounts. There's a different strategy for entering into the trade, into the trend at a discount, but that's something we could talk about on a separate video. But how do you know to grab these with confirmation? How do you know that this isn't going to just continue down? Everyone's going to comment that, and I want to make sure you guys understand. So when you apply this strategy, you're looking to fade the weak push. The weak push is important to find. If you push through a level and it kind of flops around, it doesn't get a strong move to continue, you get a lot of retesting action, you get a lot of consolidation, that's where you're going to see that pop back into your range and give you the trade setup. So I'm going to zoom into that exact scenario here because this offers tons of evidence to go long. So your key level, like I said, is over here. You push under the key level and the first candle wicks out dramatically. So that would be indication that it's not strong. If we don't have, let's jump back here. If we don't have a strong push immediately, you're looking to see if that level is going to be a reversal level, a level that comes back to the upside. Next candle comes back inside the range. Next candle chops back down to the low, chops back up to the range, down low, and then the next candle cannot break and make a new low. So this is like your better confirmation that we're going to see this level here, false break. And so when you're playing the markets, all you're doing is looking for these levels and you're looking for indications that we're going to pop back into the range and then you're going to shoot for the opposite side. So what are some factors that we like to look for? Divergence, double bottoms, double tops, engulfing candles, all that stuff. If I go through this setup, do I have any of that on here? So the first thing's divergence. Divergence is where you have a higher low in the RSI, MACD, my own indicator, the market mover, and we do. So this is where the market double bottoms or makes a new low and here makes a higher low. So that's divergence. When we dropped in the market, we already set up for that. So when you see it not push through the lows here and you see divergence, you want to start saying this is confirmation to go long. Next up, do we have an engulfing candle? Do we have a double bottom? Let's go through those things. Double bottom is cleanly right here. 1, 2. There's your double bottom. Last, do we have an engulfing candle? And the funny thing is we have all three of these come in at the same time. So right there is your engulfing candle. We go right over this last 3-minute candle and we close at the highs. So take from the body to the body, we go over that body and we close over. And then we consolidate next candle. It's like a 3-bar play. And then we push on the next one. So this is the best setup you can do, even if you're trading daily 0-day options, but FOMC again offers the biggest risk to reward. That's where we're seeing over 100% option wins regularly. You're seeing this to the upside and to the downside on FOMC. And this is not something theoretical. This is something I actually did last week. It's something I did in August, something I did in September, and we had 2 losing FOMC trades from lack of execution. The strategy worked, execution was poor. That's how trading goes though. Your execution helps you succeed. The strategy is kind of what you're going off though. But maximizing and entering off that strategy is what we're trying to get better at every single day. So putting your time in as a trader is going to help you get better at execution. And execution is how you become super profitable in full time. If you want to trade with us for 7 days inside the Discord, hit the link below. We'll see you on our daily live streams and you'll get our text alerts that we send out hopefully weekly. And I'll link a video to the right of me on my best swing trading strategy for 2024. Peace out, traders.